guess we'll get started. What's up, Yusuf? So of the people here, who's is everybody brand new? No one's like really traded yet. Maybe you've dipped your toes in a little bit, but you don't know like ICT. Maybe you don't even know like the candles, what you're looking at here. Maybe this like is brand new. What's up, Gelson? I know this isn't brand new for you. We're doing like a beginners class with some review Q&A. So if you want to stick around, if you want to have it further, just beaten into your ears, then stick around. But yeah, this is going to be a little more beginner class focus. Whoa, what is that? All right. Yep, you and Yusuf met you at Dream Ride. Welcome. How early are we with trading though? You don't know ICT, that strategy, but any knowledge of like trading, day trading? Do you have like a long term port? Anything? Very bare bones. Okay. Okay. I'll start real beginner and like intro to futures. I am going to go over candles real quick. We'll go over liquidity. We'll go over the A plus setup, fair value gaps terminology. Um, there won't be any particular order. It's going to kind of be like a high level beginner class review for anyone who's been here before. And then obviously just in chat anytime, just throw in some questions. If they're not relevant to what I'm talking about right now, we'll just save it for later. And yeah, anything you want to handle in the beginner part, Samson, or do you want me to just drill through that? What did you want to?
Um, I would say just drill through, and I'll just add on with you.
All right, sounds good. Ooh, that. Ooh. All right. Anyway,
Like, are we starting from the most like basic ICT concepts, or
I was going to start from the most basic, just trading. Welcome to futures.
okay?
What are you looking at right here?
Mm-hmm.
How's that?
Dude, we just swept out some crazy sell side.
Oh, you're watching.
And two, in the PM session, we generated some crazy LRLR, like really good generated liquidity.
It might bounce again. It might. It may
And
bounce
we
back.
swept with heavy momentum too. It wasn't like a small sweep.
Yeah, no. It may come up and take out today's like 50% and deliver off the 15 minute bearish there.
15-minute bearish.
But I feel like the high time frame draw is still like sell side, still down here.
Is your screen real quick?
Keep an eye on it. Let me know if anything looks really good.
Okay.
There might be a nice setup though, because we're in this weird area. Um,
That's what I'm
the,
saying.
the Yeah, there's a lot of liquidity beneath though. There's still so much from the news of just Powell like insinuating at rate cuts. So
Yeah.
definitely be careful. But for the beginners, welcome. This is futures. You're looking at futures indices. Two of them. There's different ones. There's like commodities, gold. I think there's different metals, all different metals. Oil. Bitcoin now has a futures. But what you're looking at right here on the left is ES. It's called ES. and this one NQ. And so the other stuff you're seeing is the contract letter that just means the month, the quarter that we're looking at. These the futures indices have expiration dates to the contract. So I believe with live accounts you couldn't hold a trade for more than like 90 days. I think that's like probably the maximum, like a quarter. And so that's the expiration is this month. I believe that's September 1st. Yeah, I think it's September, October 1st. Forget the quarters, 2025. What they are though is the S&P 500 on the left is ES, and the NASDAQ is on the right. So I'm sure some of you guys have heard of those. You know, the NASDAQ is 100 companies, S&P 500, 500 companies. A lot, if not all, of the NASDAQ lives within the S&P, so they're quite correlated. I'm just showing you right here the top, 20. It changes based on market cap, and the weight varies a little bit, but it changes, it digresses, descends as you go down. So Costco's even on this. It's not all tech. People think the NASDAQ is all tech. It's not. You got Cisco, AstraZeneca, I believe that's pharma. So it's a mix. You can actually get involved if you want in your long-term port in a more tech focus. The top 30, I believe, tech of the S&P 500. We can talk about that later. But this is futures. That's what you're looking at. ES, NQ, S&P 500, NASDAQ 100. They're very correlated. If we're looking here at any time frame, they look about the same. You see that? We're having this little squiggle going down from a big upward candle. And these are called candles. We're looking at the charts. This website is TradingView. So I recommend if you want to get started here, open up an account. You'll have to, for free, at least put, email, password, create an account in TradingView. From there, you probably want to purchase at a very small price, monthly price, the real-time data to follow along with us. But you can also just watch the screen share during my lives and not do anything for a couple weeks, a week or two, and then get into paper trading and go from there. But what we're looking at here are the candles. Candles are pretty easy to understand. There's red and green. Green, the price went up during that time period. Red, down. The bigger the candle, the more price moved. You can start to read and understand, the flow of the orders. We can get into that later as well, like depth of market, order flow. But just understand that with green candles, the market opens with a green candle at the bottom of the body. This is called the wick. So the price came down, created the wick, came back up over the open, came above the close, created the top of the wick, and then closed at the top of the body. So you have the thick part is the body, wicks on either side. Sometimes you get candles with no wicks. Sometimes you get candles with a lot of wick. It just kind of paints the picture that, again, in that time frame, what the hell happened? And what you're looking at is the 15-minute time frame. So each candle, as you're looking at this time frame, is 15 minutes for each candle. The red candles open at the top of the body, close at the bottom. So in this particular candle here, it opened, price came up, created this little wick, came down beneath the close, created the little wick, and then before the 15 minutes closed, ended here at the bottom of the body, the close. So price would move here, up, down, here, up, down, like that, open, boop, 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 like that. And so you can kind of see the flow of price, okay? And you have highs and lows. Everywhere you're going to see highs and lows. More significant highs and lows are swing highs and lows. And all that is for the example of a swing low, it's where you have this right here, a low, a lower low, and a higher low. It's a 3-candle formation where you have wicks that create, for a swing low, a low, lower low, and higher low. Another example would be this one here during the London session. A low way up here, the lowest low, and a higher low. That is a swing low as well. The Asia and London sessions are marked because those are time periods where a lot of liquidity happens. Those are the sessions in which those areas in the world trade. So for Asia being about 12 hours different ahead of us, they trade 8 p.m. Eastern to midnight, because about 8 a.m. to 12 p.m. their time is their trading session, their morning session. London, 2 a.m. to 5 a.m. Eastern, because again, they're about 5-6 hours difference depending on daylight savings time. But back to the highs and lows, right? These are important because it's where liquidity rests. It's why the market wants to go up and down. When you see swing lows like this, there's stop losses beneath this. People were going long here and they rested their stop losses at the low. And so there's liquidity resting there. The market wants to travel and take out those, in most cases, those retail traders that are trying to, trim and get their money like we are. And so the retail trader, we can just press the button. We're dealing with a very small amount of liquidity. We hit the market buy, market sell button, and you're in the trade instantly. There's a little spread. It's not too large. It depends on the data feed you get. We'll talk about that in another class. It's pretty technical. But essentially, price is moving from premium to discount. Okay. And we can just press that button. The big institutions, however, cannot just press the button. They need to generate the liquidity. And so that's why price moves so chaotically throughout the day. You'll see on the news, on CNN, oh, the Dow went up 100 points, the NASDAQ moved 200 points, things like that. But in reality, it actually moved around a lot more. And so, where do I want to go from there? Moving from premium to discount. The big institutions, what?
We just inverse on the 1 minute.
Oh.
This could be a potential long. I don't know if I want to take this. I'm just letting you know.
Yeah, I know. I do like the wick down there. It's just there's such.
What do you think? Because you've definitely taken more after hours trades than me.
There's nothing stopping it really from getting to 520. Yeah, I mean, it might be a break-even trade, but I think you're going against, in a high time frame, against the order flow. Because if you look at the 4-hour,
Yeah.
This is an order block because, this 4-hour candle closed well below this. Then we had an upward candle, and we're kind of in the middle of a potential order block because we're like right there with an hour 40 remaining.
Yeah, I see that.
But again, that's just utilizing order blocks. We went into an hourly 4-hour bullish fair value gap. So I mean, it's gonna pop. It's meant to pop, and that's what it did. But it also crept into that 1 minute bearish. And that's not one that I would take. I like a higher time frame inversion if we're gonna take that long like that.
Yeah,
I would want at least a 5-minute confirmation inversion.
You're right.
No, I'm not right. It's just like I want to be more safe. This could still, deliver and pump quite a bit.
I didn't enter. I was just seeing like what you thought about that trade.
Yeah. But with liquidity, the institutions, again, they cannot just press the button. So what they want to do, what they have to do rather, is if they want the market to go up, they actually start to make the market go down. They sell, and they cause a sell-off. And then your trend traders, your turtle traders is what they're called, who are using support and resistance, will see a lot of times resistance get broken. And then in cases you'll see a buy side get broken, you'll have equal highs or something. a bullish gap above it or a bearish gap above it. And there'll be that breakthrough, and a lot of people will long that. That's their confirmation, is to long that. Psychologically, you'd want to long it. You see an uptrend, you see a break of that resistance, you see new support, even perhaps, which could even just be a manipulation leg. We'll talk about that in maybe today or later class. But all it is the big institution that needs to generate the liquidity to flip the switch to do a reversal. Because for every buyer, there has to be a seller. If they want to buy $1 million, a million shares, or even more, 1 million shares of something, there has to be a seller there as well. Okay? So it's give and take. So in order to generate that liquidity, the market makers will do the following. They'll create a breakout of that resistance. Your turtle traders are going to go long here, but all it is the generated liquidity to form the reversal and create the dump, the reversal down. Everyone gets liquidated who's trying to go long here. Okay, because when your stop loss is hit, you're essentially buying back your position. You're giving that money back to the market. And so that's allowing for it to get filled, as well as many other traders, to allow the institution to then short, because they've created the false pump. Everyone was in a long. Okay, that's very high level what's going on. As in a digression here, the market makers will also, like, if someone's trying to buy $10 million of something, like a retail trader, the market makers will actually see that, and one person in the institution will basically fill that order then, but then will look for a seller later on, essentially taking the financial hit to allow price to come down, only to then make the reversal. It gets more technical as you get into it, but that's essentially what the market maker is doing. It happens with all the indices on every chart possible, especially with like gold. You're buying the actual gold as you're selling the paper. So the price of gold is going down, so you're buying at a discount real gold, and then that same institution is doing the opposite. As the price of gold goes up, you're selling the real gold, so they're constantly profiting. LRLR, yeah, it's low resistance liquidity run. I did just do a little video on TikTok and YouTube and Instagram about that. It's just like here. So it's just very tight, linear trend of price. You could literally just draw a trend line. You should be able to get at least 5 perfect touches on it. Again, these are all stops resting above. Notice how there's no higher high. These are all lower highs. So every stop loss above here has not been hit. Eventually, the algorithm, which is what's actually moving the price, filling the orders, is going to want to come up here and take these highs out. This is all engineered liquidity to the sell side that now needs to come back up. So eventually, yes, this buy side will get hit. It's a matter of when. Obviously, that long is not looking so good. I think, yeah, like I said, the draw is down here on Asia. So so that's basically liquidity. What we do with that, though, how we get into a trade, is the setup. So the confirmation of the trade is the setup. It is the A+ setup. I don't take setups that aren't less than an A+. I like to have a minimum 4 confluences. One confluence is being in discount when you're going long. Discount being the sell side down here when you want to go long. Why? Because statistically, if you're oversold, if the price has gone down so much, well, it's meant to go up, right? So we draw, a Fibonacci retracement, which is what this tool is. And that just gives you the high to the low and then your 50% line. So whenever price is above the white 50% line, you're in premium. Below, you're in discount. And so when we start to see highs equal highs, that engineered liquidity, those target points, when we see highs, Asia high, London high, any significant high that gets swept, we look for this. This is the setup. This is how we get into the actual trade. It's typically during the New York AM session. Why? Because there's the most volume, there's the most good volatility, prices moving a lot. Um, in this case, this example, London high, so that's again the 2 a.m. to 5 a.m. Eastern time frame, is swept. You can see price came up just into it. There was strong momentum because it's just wick. We don't like if there's just a body up here. You want to see the wick created. That tells you that in that time frame, price came right back down to its body down here. This is like kind of called a doji candle. And so this candle here that has an enormous body, this is called a fair value gap. This is where there's a lot of institutional trading. So when you see huge green candles or huge red candles, they're called liquidity pools, like magnets. They want to pull price back into it. Price wants to fill typically these gaps. You'll see price come back, it tipped into this, it completely filled this gap, wicks down, completely filled it, came back up, and then wanted to obviously continue down to what this is the take profit TP. But your big candles with nothing beside it, right? So it's usually a 3 candle formation. This candle, the big candle, and this candle confirms your fair value gap. These wicks here are irrelevant. It's just what's right beside it. Okay, that's your fair value gap or your FVG. Okay, so you have the fair value gap, you have your strong wick, and then right after 2-3 candles, you have the inverse or inversion fair value gap. So it's another FVG, fair value gap, that completely disrespects in this case, the bullish momentum. So it came up, it had to grab some stop losses in price, and it inversed immediately, closing off this bullish gap. That's your IFVG setup. What you would do at this candle close, so when the timer reached 0 and confirmed you're beneath here, closing what we call under the gap, you would hit market sell. You would set your stop loss to what we call the close above, or subjectively, sometimes it's just a little bit higher. So that's your close above, because again, here's the gap. Here's your close above. But we chart on NQES and we execute our trades on MES and MNQ, the micros. So you take a tenth of the actual size of a full contract on a trade on ES or NQ. It allows you to not lose as much money and take trims, because you never want to take the full micro and not have the ability to take trims, especially as a beginner trader. So that's what we're looking for. Fair value gap, quick momentum, wick, IFVG, closing it, market sell, break even goes here, next liquidity, next internal sell side liquidity, which would be this low, swing low. Or if you want to be a little more lenient with your stop loss, or excuse me, your break even point, it would be the next liquidity pool, which is this bullish gap. So when price came down into here, that would be your stop loss to break even. And so what that simply means is when price hits the break even BE point, you move, you drag your stop loss to where your fill price is. And that way you eliminate any losses if price were to come back. Because if price enters the liquidity pool here and continues bullishly, because that's what price wants to do when it comes back into a bullish gap. It more than likely wants to use the bullish momentum and bounce off of it, almost like a trampoline. And so that'll kill your trade. And so we're a little more disciplined here. We move that stop loss to break even pretty quickly because, again, we want to stay in this as long as possible. We want to mitigate the risk, mitigate the capital loss as much as possible. And statistically, what we found is that when it comes back down price to your entry and were to hit that break-even stop loss, it's going to go further into losses. And it's just not necessary to take any losses. It's probably going to be a completely failed trade and hit the majority, the entire original stop loss. So it's just the smart thing to do. It's what we always do. I'll comment on the trades when stop loss is moving to break even. Samson will do that as well. Super important. Super important. Some traders don't use a stop loss, and we're baffled by that. We don't understand how you cannot use a stop loss. But to review the A plus setup again, because we kind of digressed into the fair value gaps, is you have the FVG. It's coming up sweeping major liquidity. So the entire 3 hour, 4 hour window of London session, that's swept. So for an example, London high would need to be higher than Asia. So consider this the London high in this diagram. That's swept. It's a major high, major buy side liquidity swept. During the New York AM session, we're obviously in premium in the daily range to be going short. And a strong momentum close. And other important things are the clear targets. Okay, targets are super important. Those can be data. Data is when news comes out at 8:30 or 10 a.m. They create huge candles. Data highs, data lows are your best targets, and we have a one setup for life. We call it OSFL. The only thing you need to really know as a trader to make money is just take data trades, OSFL trades. But we utilize that as target points, as the S tier target points, or other S tier would be equal highs with a ton of candles separating them. We also have on our charts indicators that show that. So we actually have the equal highs and equal lows indicator. If you go to my frequently asked questions, the FAQ section in the education folder, it tells you all my indicators and how to customize them. And what those do is it will indicate exactly that, equal highs and equal lows when they show up. You don't have to put it on ES. We put it on just NQ because ES doesn't move as much. But that would be S tier targets for your take profit. I can't iterate enough that your take profit, your exit point of the trade, is as important, if not more important, than getting into the trade itself. So as you see the setup, you need to see liquidity resting above or below where you're trying to get into the trade if you're getting into a long or a short. Okay, you can't just see an IFEG setup, 3 candle formation, and just take that trade. There needs to be the liquidity sweep. There needs to be a bunch of different criteria. And some of those other criteria are protected lows. And so that adds an even higher level of confluence to a trade. And so what that is a swing low or a protected high, a swing high. But for a swing low, protected low example, it is a swing low inside of a fair value gap that gets taken out by another swing low inside the same fair value gap. So this right here is a protected low. If you could find a long out of this, it's actually another level of confluence. So what's probably going to happen is price currently, we're looking at it right now, it's going to come down, sweep the sell side IRL, internal resting liquidity. That's called IRL. ERL is external resting liquidity. Price wants to move typically from IRL to ERL to IRL to ERL. But price is going to come down here, take this out, and it's going to deliver from here. Now, I'm not too sure about a third low, swing low, taking out the second swing low, if that is another protected low. But on a high time frame, this is still cooking up to be a protected low over here. We have the swing low, we have this low, lower low, we have to create a higher low over here. So for me, again, a high time frame reversal is valid over here. It might present itself later tonight by 9, 10, 11 p.m. Things do start to die down as time goes on in each session. But yeah, targets are super important. Another level of confluence other than protected lows are SMTs, or smart money tool or smart money technique, SMT. We love using SMTs. A lot of traders use SMTs. ICT traders use SMTs. Some traders will never take a trade when there's an ICT, when there's an SMT. You'll gain your set up your strategy. You'll fine tune it from mine maybe in a while from now. But for now, we like SMTs. And what that is when this index is uncorrelated with this one. And it happens a lot. And that's just when one of these, let's say ES, takes out some buy side liquidity when NQ does not. And that happened today. Yes, it did. Right here, we had a bearish SMT. Bearish because price was to go down. We swept the buy side. We took out London high here. See? That wick just took out London high. That same wick over here on NQ is lower than this one. If I were to draw that out, you'll see that is a descending trend line. And the same one is this one, this one. And that is a ascending trend line. So what happened here is ES took the buy side, NQ did not in that same time period. It stayed below. And so that's your bearish SMT. They're uncorrelated. Prices to go down because you swept buy side. So there's your ES bearish SMT. And from what you can see, it absolutely delivered and distributed further to that sell side. And that was the move today earlier, but there wasn't really too good of a setup. That was the only thing. It was just right here. You had to just get in right about here. That was the close under. It didn't get into any other liquidity pool. Stop loss to break even could be here, or for me, it actually would have been here, because on this time frame, I don't see any fair value gaps, do you? Until here, there's a little one. And notice how right here, whoa, price did wick just into it, and then it did react a little bit. But the order flow was bearish, the SMT held, and price kept distributing to sell side. I did take a small little scalp short here at the end of the day. I didn't alert it because it was a terrible trade to have alerted. But I took like 40, 60 points here. But what else? Am I missing anything, Samson?
What do you think? I mean, you covered SMTs, you covered basically entry models, fair value gaps. Does anyone else have any questions?
There's so many other little tips that I'll just blurb out throughout live trading. Samson, I will always just give little tips. Like there's things like there's days you don't trade. We'll be telling you on days that to not trade. Such as NFP is the next day. You don't trade the day before. Things like that. You don't want to short a V-shaped recovery. There's little things that will tell you that it just experience has gained.
Alan, how to figure out a daily bias. Usually we mark out higher time frame PD arrays or like higher time frame imbalances and target those. Like London high, London low, Asia high, Asia low. Any imbalances or draws of liquidity on the 15-minute or above. But typically for me, I don't really have like I don't go into the market in the morning and say I want to see the charts go here, here, and there. I kind of wait and react for it to sweep or deliver from something, and then react off of that. What are the other things to consider besides fair value? What were we gonna say, Levy?
We have like a morning checklist like for daily bias. Typically like 15-minute and 1 hour. We look and see, are we in a fair value gap? Is it bearish? Is it bullish? If it's bearish, we're going to look for a reaction for a buy side liquidity sweep inside that higher time frame, again 15 or 1 hour, to the sell side. If there isn't, or if we're not inside of a gap, then we wait for a major liquidity sweep that is then inside externally of another fair value gap. So you take out something like this high, which is inside this bearish area. That's the short that we like to take. We like to take, a long where we're going to sweep this low right here and deliver bullishly out of this bullish fair value gap. Okay. We love red folder news. So if there's red folder news that day, that's a great day to take a trade. Specifically, data is going to give us maybe the one setup for life. But yeah, definitely if you're not inside of a fair value gap, we wait. No reactions, we wait. We do absolutely nothing, just watch price until an intraday equal higher, equal low is formed. We like to react, not predict. Um, yeah, that's about it. We're taking that low out right now.
What are other things to consider besides fair value gaps when taking a trade? Oh, did you cover that or?
Just like other things to consider
Yeah.
when taking a trade. Oh yeah, time of day, day of week, um, order flow, volume, um,
Price action.
price, yeah, premium discount. Um, Sometimes order blocks we're just keeping in mind. They help um, just confirm a direction sometimes. Um, what else?
I've seen people make money on the price drop. How does that work? That's called sells. So when you're in a sell, you want to see price drop lower. That's when you make money. When you're in buys, you want to see price push higher. That's when you make money too. I definitely want to see like a checklist because I want to practice more on it and also add other confluences for sure. I don't think we have like a physical checklist, but we could work on that. Levy, do we have like a physical? You don't have one, right?
I can make one. I can make like
It's
a little
more.
infographic.
Yeah.
No
So
problem.
we do that. Is marking out all highs and lows a must need? Um, so I like to mark out highs and lows. Well, me and Levy both like to mark out highs and lows on like higher time frame, on higher time frames at least for biased. At least that 15-minute or above. Are order blocks and fair value gaps related? But not. I think so, right?
What was the question?
He said are order blocks and fair value gaps related?
Um, I mean, they're
I mean, an
related.
order block on a higher time would just be a lower time frame inverse.
They're just two different concepts. They're like just two different vocabulary terms. So a fair value gap is that candle, just like you see here to the left, this big green candle. That's your fair value gap that's been created out of this candle. The fair value gap, whoa, is the actual gap from this bottom wick to this high wick on this time frame. That's your gap. I'll just draw it out. And then an order block is just something that's a three candle formation during price action that confirms that price was just trying to take out people going in the other direction. So, for example, here's two order blocks, and together they are called a propulsion block. So you have a green candle, red candle, green candle. Think of it as like a sandwich. You've got your bread, peanut butter bread, right? This green candle, the red candle wanted to come down, take out all the people who went long here, all the way below the open of this candle, right? Price went way below as well. The wick shows you that it just took all these people out, swept the sell side. But the bullish candle after closed well over the open of this candle. That's your order block. That's how you see it. The next candle has to close over the middle candle. That's your order block. Then another green candle, red candle. These are connected. You take the two green candles together. Actually, all of these are technically connected. So that's order block, another order block. Two order blocks is a propulsion block. So it pushed price a little bit further. Um, I've not had enough data around three order blocks, but typically, order block is a propulsion block and will take price a little bit more in that direction. But again, yeah, they're two different terms, two different things. I guess the other thing I want to just briefly mention is that when you take a trade, we were talking about ES and MES and NQ and MNQ. So there's different charts. You'll have to have another whole tab open with two more indices, where you'll have just it's just like this. You just type MES, and that's the micro version of the full mini ES. But when you take a trade on ES, every dollar moved, every point is a dollar. Every point moved on ES, when price goes 6435 to 6436 and you're in a long position, you made $50. That's a full contract size on the ES. On MES, since it's a tenth, is five. It's only $5 when you take one micro. So you can take 10 micros to make it equal the one mini of ES. So 10 MES micro contracts will be a full mini. Okay, and that's why we like the micros and we execute on the micro charts, is because it allows you to get into, let's say, 6 micro contracts, so not even having to take the full size of a full mini. And then as price is going, different liquidity pools, you can trim, you can, of the 6, take 1 micro off the table and realize those profits, or take 2 2 2, or take 3 2 and leave a runner, because you want to see if price will just continue going for the hell of it. And there's some cases where we will leave a runner. Not every trade will you want to leave a runner, but sometimes it's smart because price may just keep going. You want to hold your winners. You do want to know when to cut your losses. Again, that's why we use the stop loss. But with NQ, it's different. It's not $50 for every point or dollar moved. On NQ is 20. So the micros are 2. Okay, every tenth of the mini is $2. So when you take one contract on MNQ, you're making or losing $2 for every point, every dollar gained or lost on the chart. Okay, and real briefly, if you are going to be paper trading, we have this in, again, the miscellaneous channel. This guy here, which is how to actually size your trade. So how much risk you want to always keep the risk. So when we get into the live trading tomorrow, if you want a paper trade, which is fake money, you'll just paper trade on TradingView. I can talk you through it. Very easy. You just say, X amount of dollars, and then you can trade with it. It's not real. But you always want to keep the risk amount pretty much the same, especially with those A+ setups. When we're always being disciplined to take the same type of great setup, we want to be strict. We want to take the same size risk. And what I say for a beginner, a nice size is probably $100 or $200 risk per trade. And how you would see that on the chart is when you take this trade, you notice that prices here and here, let's say this whole gap is 20 points. So if it's 20 points, that's your point risk here, 20, right? Because 5 times 2 is 10 times 20 is 200, right? Because you're trading on the micros. So 5 micros is 2 times 5. So you're trading $10 now per point, times the $20 stop loss is a $200 risk. Does everyone understand that? Is that confusing for anybody? So again, with $400, if the stop loss was a 10-point risk, the size that you had from your entry to that close above, or the subjective where you want to put your stop loss, if that was a 10-point risk and you're risking $400, you can use 20 contracts or 2 minis, because it's a tenth, right? And so that's 20 times 2 is 40 times 10 is your 400. Okay? And so this chart is available. You can screenshot this, or you can save it from the miscellaneous tab. Super helpful to allow you to quickly do the math required to get into your trade, because you want to get in as soon as that close under or close over occurs, as soon as it happens. Anything else, Samson, or any more questions?
On a bullish investor value gap, when do you sell? Um, so you have draws on liquidity, like buy side. Buy side liquidity, you typically want to have a TP there, or you could trail once that gets swept. Um, so yeah, or when we hit like a higher time frame imbalance, 15-minute or above. So like buy side liquidity, a swing high or high time frame imbalance is when you typically want to sell. Can you legitimately trade on TradingView or fake trade on it? So for TradingView, you could just do paper trading, which is not real money. But if you want to real trade through paper, through TradingView, you have to do it through like a brokerage where you can connect TradingView through. For example, like Tradovate, you could deposit, like 10 grand on Tradovate and then trade on that through TradingView. So it's smarter to do quick buy and sell, or buy, sell, or hold it for a little bit, then sell. I would say to hold it for a little bit, then sell. That's kind of the strategy I use. Um, but again, it depends on your edge, your strategy, your entry model, and it depends how quick the trade's going to hit your TP or how quickly you get stopped out. So, one day you could end up holding a trade, your exact strategy. That trade can go to your TP in like 3 to 5 minutes, while other days where price action really isn't the best, it could take 15 to 20 minutes for that trade to hit your TP. TP is take profit. I love you just said it. Guys, if you ever have any problem with the terms, there's a tab for that under the tab called under vocab terminology. If we ever say it like if we ever say like anything, you just don't understand it, look under that. So what's a bearish fair value gap? It's the same thing. A bearish fair value gap. If you scroll up and you see the two images I sent, as you see that before inverse, that's a bearish fair value gap.
Wait, are you sharing your screen?
No. I was showing him I could share my screen.
Oh no, I just thought you were, and it wasn't being shared. That's all.
No. I sent two images at 8:23 your time. So it was the first one. The first image is a bearish fair value gap. 8:23 Eastern time. Keep scrolling up. You should see it. Do you see it?
What?
The two images I sent.
In the chat?
Yeah.
In this class chat?
Yeah.
No, I don't see anything that you sent.
Really? At 8:23 your time?
Oh. Oh yeah, I see that way up there.
There we go. Yeah. So the first image is a bearish fair value gap, and when we disrespect that with a bullish fair value gap, that's an inverse fair value gap. So do I sell on a bullish fair value gap that's inverse by bearish? Exactly. Yes, you do. But again, that has to be aligned with other confluences. Like you can't just enter off a fair value gap in the middle of a range, But yes, you do have the right idea. But he means a short position or actually close the position. A short position, meaning you enter cells. You guys have any more questions?
I guess for homework for people, are there no one wrote anything, right? Yeah, people are writing, but while they're writing, for homework, if you don't have it, get TradingView, um, get familiarized with it, click around. You may have to customize the colors and some things, and if you have any questions, just DM us, obviously. But definitely homework, get TradingView, start to mark highs and lows with the little line, and see how price reacts when it goes below those lines, and rate what you think the IFVG, if you get a liquidity sweep and you get the inversion rate, um, on a scale of 1 to 5, if you want, how you think the reaction was, and then, or just get into the paper trade itself, and just practice. But by tomorrow, yeah, definitely try to have TradingView, make the account. You might want real time data. If not, just watch the screen share, because we'll have that going so you can see clearly what we're looking at. We can talk you through it. Anything else? And we'll digress into more concepts. Like we can get into more about the propulsion block. We can get more into the power of three: accumulation, manipulation, and distribution. Actually, we can do a little bit of that right now. Samson, do you mind? Or I can do it.
Yeah.
Either or.
Yeah, I can do it if you want.
All right. Oh yeah. Thank you.
All right. So I don't know if you guys are familiar with the term AMD, also known as like accumulation, manipulation, and distribution. So we just need NQ for this one. Let's see an example. So typically we get an AMD during market open. Pre-market, we get the accumulation. On market open, we get the manipulation, and then from there we get the distribution. So let's look at today's example, right? So from pre-market, we have generated a good amount of accumulation Well, actually, today we delivered from this sell side right here. So this is a low at 630. So this is sell side. Then Lobby, this was a London low, right? I think I have to get a new indicator for the Asia and
Yeah, I think it is.
6:30 a.m. New York time.
No, it'd be 2 to 5.
2 to 5. Okay, so this indicator is a boo boo then. Okay, so yeah, this low was pre-market lows, not London low. So as you can see, we're generating some sort of accumulation pre-market. Then boom, we got market open. We come down. We get the manipulation. We fake people out thinking we're gonna push lower. So look at the accumulation, manipulation. We swept sell side. We inverse, and then we got the distribution all the way back up to Asia high right here. And that's kind of something you want to look for. Even if you're not looking for that, a lot of your setups, your best fair value gaps, and sweeps of buy side or sell side, you're gonna get some sort of AMD on all time frames. So this right here is London. Oh, it's Asia high. My bad. Yeah, so this was accumulation, manipulation, soap sell side, and then from there we got the reversal, which is the distribution. Let's see another example of this. Funny enough, this was Friday. So pre-market, we had, let's see, 2 to 5. It's 3 to 5 for London, right?
2 to 5 a.m. Eastern.
Okay. So yeah, let's go to a higher time frame. Let's go to the hourly. Let's drop down to the 15. All right, perfect. So we have multiple 15-minute sell sides and imbalance. Sell side, sell side. We also have a high time frame imbalance. I think, yeah, we have an hourly imbalance right here. We scale down to the 1 minute. So what happened off of market open? Pre-market, we get the from 4:20 a.m. We're accumulating, generating liquidity on a relatively high time frame. And then off market open, we get the manipulation. So people are gonna think, okay, we got this push lower. We got this bearish move. We're gonna push lower. That's the manipulation. We're manipulating a lot of sellers right here. A lot of people are gonna enter sells. We reverse, and then we get the distribution. Obviously, it was news. I think that was Powell, right?
Was that Friday? Yeah.
Yeah, yeah, it was definitely Powell. Anyways, yeah, we get the accumulation, manipulation, distribution. So this is kind of what you want to look for in your setup, or at least delivering from market open. Obviously, not every setup is going to be an AMD setup, but a lot of them are. Let's look at one more example. 30. It's not a good one. Also, when we look for the AMD, we want to see a sweep. So we don't want to just see a random push up and then a reversal. Let's see. Okay. Um, this isn't the best example, but I'm just gonna turn it into an example. So let's say we have huge sell side right here. This is obviously a higher time frame. This is sell side. And we have pre-market buy side right here. So obviously we're not delivering off anything from this inverse, but let's say off market open, we get this wick up and we sweep buy side liquidity. Pre-market, we got the accumulation, manipulation, faking out a bunch of buyers thinking we're going to go higher. And then we get the distribution. So, I mean, if you guys want more examples, just go to Google and search up AMD accumulation, AMD ICT. You see a lot of examples. So this is just kind of one of the things we're looking for when we're looking for entries. You know, Asia high and Asia lows. I use an indicator. Actually, Levy, what indicator do you use for Asia high, Asia low?
It's called ICT kill zones and pivots.
ICT kill zone and pivots. Okay, I'm gonna remove this one because that indicator is boo boo.
Yeah, ICT kill zones plus symbol pivots by TFO. Or parentheses TFO by trade for op.
This one, right?
Yes.
Okay. So if you guys also want to add the indicator too. There we go. Okay, this is what I was looking for. Wow. And so this is more accurate, right? So guys, you could use this to see when we're delivering from a London high, London low, Asia low. It's an amazing indicator. The other one I was using wasn't so accurate. This one actually, this is amazing. It literally marks out London high, London low, and even previous days highs, previous days lows. And yeah, Olivia, is there anything else should we cover?
No, that's pretty good. I threw in the chat a chat GPT that's geared just towards ICT. So if you have any other, intermittent questions, lingering questions, and you don't want to just, I mean, of course, send them to me, Samson, throw them in the chat. But if on your own you want to start learning a little bit extra, that link right there is amazing. But yeah, I think that's about it for tonight. We'll just keep it to like a little hour, and this was recorded, so you'll be able to view this again. I'll put it on YouTube and I'll link to it here in the Discord. And trying to think if there's anything else. I think that's a good just starting beginner course. Hell yeah. Awesome. Cool. Well, tomorrow we have durable goods, 8:30 news a little bit, and then consumer confidence at 10 a.m. So that should give us a little something to potentially work with. Don't forget to review the FAQ and miscellaneous tabs. Don't forget to verify your profiles if you haven't yet on Discord, and then also click show all channels in the dropdown of the server. It's important to be able to see all the different channels. There's a ton of value in here. And if there's notification settings, make sure those are on too, because I'll signal and put in index commentary. You're getting daily bias, daily recap, tons of stuff. So stay tuned. But yeah, that's it for tonight. Thank you so much, guys.
All right. Amazing class. Love you.
Amazing class, Samson. Thank you so much.
You too, Brody. Thanks for everyone for showing up. I'm out.